Not all income strategies are created equal, and I don't just mean differences in yield or expenses. When the AI bubble bursts, some are likely to do much better than others. As Warren Buffett said, you don't know who's swimming naked until the tide rolls out, meaning you don't know who's taken on hidden risk until something goes wrong. So, in today's video, I'm going to rank over 200 income ETFs based on their vulnerability to an AI crash so that you can see which ones are swimming naked, i.e., taking on a lot of AI risk. Of course, we'll also look at which ones are likely to thrive in an AI crash, and there are some very popular income ETFs on both sides. So, for dividend investors, this video is a must watch. How did I do it? Well, for some background, I recently did a massive study for this video where I compared the daily returns of every stock in the S&P 500 over the past year to the most comprehensive AI index I could find to see which areas of the S&P were most and least exposed to AI. I went into greater detail on the process in that video, but for a quick overview here, I basically looked at how similar each company's returns relative to the S&P 500 were compared to the AI index's returns relative to the S&P 500. Put differently, if a company consistently beat the S&P on the days that AI was also doing really well and then trailed the S&P on the days that the AI index was trailing the S&P, I consider it to be highly correlated with AI. Those are the companies that are the most vulnerable to an AI crash. If it consistently did the opposite, it beat the S&P on AI's bad days and trailed the S&P on AI's good days, I called those negatively correlated. Those are the companies I would expect to do well in an AI crash. I did it this way because AI has driven many areas of the market beyond just what you might think of as AI companies like NVIDIA or Broadcom. It's things like utilities or gas turbine makers or uranium miners and many other seemingly unrelated areas that have also gotten caught up in the AI hype. So your true exposure might not be what it seems like on the surface. That's why for this video, I looked at every ETF with a 2% or higher yield in all the US stock, derivative income, aka covered calls, and leveraged ETF categories. Over 200 ETFs in total against that same AI index to see which ones might be set up for success and which ones are swimming naked. I also expanded the time frame a bit to include the last couple of weeks through Friday, November 21st. I'm not going to go through all of them one by one, but I will take you through the best, the worst, and all the popular ones that I think you might ask about. If I don't cover one you're interested in, let me know in the comments and I'll tell you where it sits. The one with the most AI risk, probably to nobody's surprise, is AIPI, the Rex AI Equity Premium ETF. I'm guessing not many of you hope to avoid the downside risk from AI by investing in something with AI in the name, but if you thought that that 36% yield was going to save you, my research suggests that's not very likely. Most of the top 20 most vulnerable ETFs are tech or NASDAQ covered call ETFs and tech related single stock covered call ETFs. QSIX from Pacer, TYLG from Global X, FEPI from Rex, and QXQ from SGI round out the top 5. Other ETFs that we've done deep dive reviews on in this channel that came high up on this list include GPIQ, QQQI, and QDT. Those are all in the extremely highly risky range when it comes to an AI bubble. One step below that, but still very highly exposed, are options like QDVO, JetQ, SVOL, MSTY, and TSLY. A few less obvious ones that I found to be surprisingly risky were WiMAX, the YieldMax Ultra Option Income Strategy that combines a bunch of their different covered call ETFs. That one was actually one of the riskiest ETFs of them all. Literally just one spot below the YieldMax NVIDIA Option Income Strategy ETF, NVDY. EET, a leveraged emerging markets fund, was also up there, and I found that to be pretty surprising, but it's probably a combination of the leverage and also the fact that emerging market stocks have been driven a lot by Chinese AI over the past year. NZUS, the Spider Climate Paris Aligned ETF, was also very high on this list, but mostly It was the ones that you'd expect, like US tech-oriented ETFs. Before we uncover the ETFs that are least exposed to AI and likely to do the best in an AI downturn, one thing I've been struggling to uncover is why over 70% of you who watch this channel regularly still haven't yet subscribed to it. A little inside baseball here. I worked about 60 hours this week in my job as a full-time investment professional, but I still got up at 6:30 a.m. on Sunday to make this video for you. So far, it's taken me about 6 hours, and after I record it, there's a lot more work that has to be done. Kyle and I do this because we care deeply about helping regular people like you significantly improve your lives by becoming better investors. But we can't do that if you're not subscribed. So if you want to significantly improve your life, or even if you just want to say thank you for the many hours we've spent researching hundreds of companies and funds for your benefit, please do us a solid, do yourself a solid, and hit that subscribe button. Thank you so much. All right, the 5 ETFs with the least exposure to AI are SIXA, the ET6 Meridian Megacap Equity ETF, XRLV, the Invesco S&P 500 X Rate Sensitive Low Volatility ETF, UGE, the ProShares Ultra Consumer Staples ETF, DHS, the Wisdom Tree US High Dividend ETF, and Noble, the ProShares S&P 500 Dividend Aristocrats ETF. These aren't terribly surprising. The first one uses factors that have historically led to long-term outperformance to pick stocks. And some of those factors are things like high yield, value, and low volatility, which all kind of point away from the AI stack of companies that have low yields, are growth-oriented, and have been highly volatile. The second one specifically targets companies with low risk and limited exposure to rising rates, which basically eliminates most growth companies. The third one is one I've been buying, which we covered in our last video as a possible option that could do well and minimize exposure to AI. And then numbers 4 and 5 are pretty indicative of most funds that are the least exposed to AI. On the high end, it was tech exposure, and on the low end, it's mainly dividend and value-oriented ETFs that show up here. Others we've covered that score well include Devo, DGROW, SCHD, everybody's favorite, JEPI, Poppy, QDIV, Bali, and FDVV. And some that scored not quite as well, but still very good, and in some cases surprisingly good, include SPYI, GPIX, and XYLD, among some other S&P 500 covered call ETFs. Interestingly, QYLD, which is a NASDAQ covered call ETF, actually slightly made the cut on this side. It's not nearly as likely to do well in an AI bust as some of the other ones that we've just mentioned, but it is perhaps likely to do better than other NASDAQ covered call ETFs in that scenario, which is something worth considering if you own any of those. Before we wrap it up, let's take a deeper look at SCHD because I know a lot of you own it or have owned it in the past or considered it, and I also know a lot of investors have not been very happy with it lately. SCHD did pretty well against the S&P 500 in the rising rate period of 2021 and 2022, particularly in the down market. But then as tech and AI regained their dominance since 2023, it's fallen significantly behind the S&P. Does that mean it's broken? No. It means it's negatively correlated with AI, and when sentiment on AI cools down, SCHD and these other highly negatively correlated ETFs are likely to shine again. So if you're looking for something to complement a high growth position like something in tech or NASDAQ related growth, momentum, I think SCHD is a great option for that, even as a complement to the S&P like VU or an SPY or something along those lines. In fact, I looked through their top 10 holdings, and 9 out of 10 of them are highly negatively correlated with AI. They're in areas like energy, healthcare, defense, consumer products, so they makes perfect sense. Those don't really have much to do with AI. The 10th company, Cisco Systems, was sort of like the NVIDIA of the internet bubble, but its exposure to AI is much more muted, meaning that whether AI is doing well or poorly doesn't really mean that much for Cisco stock. SCHD did own a big position in Broadcom in the past, so it's possible that it, or pretty much any other ETF, could have more AI exposure in the future, But for something with a dividend, low volatility, or value focus, that's pretty unlikely to happen, in my opinion. I actually think SCHD has a real chance to get its mojo back at some point in the near future, whenever the shine comes off the AI trade. If you found this video helpful, please be sure to hit that subscribe button on the way out and leave us a like so the video will get out to more people. More people will leave us comments with good ideas, and the next video will be even better. Thank you so much for watching, and we'll look forward to seeing you in the next one.